All right, guys, something that we're talking with our clients often is about paying their taxes quarterly. So if you're a small business owner or somebody who has a consulting or gig work, something where you're not having taxes withheld from you, chances are you're paying your taxes quarterly or you should be. So that's where a firm like ours comes in. I want to talk to you about how to pay those taxes quarterly and some strategies and even some terms for you to understand around paying your taxes quarterly so you do it better. Okay, so IRS is a pay-as-you-go system. The states are as well. What that means is, for most people, they have their taxes withheld from their paycheck. Again, you're not paying your taxes at that point. You're just having them withheld, and then you reconcile when you file your tax return. But most people, that's what happens to them. Their taxes are withheld from them. Essentially, they're paid. They get a refund or a small amount when they file their tax return. But small business owners have to calculate and pay in their taxes quarterly. Now, let's start with the due dates, which are funny in and of themselves. The first quarter is due April 15th, second quarter is due June 15th, third quarter is due September 15th, and the fourth quarter is due January 15th for the prior year. So you would think that you would do it on the 15th of the month following the quarter end, like April, July, October, January, but that's not the case. So just remember that. But here's the biggest thing. You have to pay in one of two things so that you are not penalized, right? And really, it's not even a penalty. The underpayment penalty is interest on your taxes that you owe quarterly. Again, refer back to what I just said. Taxes are supposed to be paid quarterly. It's a pay-as-you-go system, okay? So two ways to pay in the way you don't have a penalty. You'll have to pay in what's called the safe harbor, which would be 110% of last year's tax or 90% of the current year. And I'm gonna give you some ways to do that. So if you wanna know what 110% of last year, so that would be 2025's tax is, grab your tax return, go to the total tax line. Let's do some simple math. Let's say your tax last year was $100,000. Then for 2026, in order to avoid penalties, you need to pay in $110,000 quarterly. So that would be, what would that be? 27.5 per quarter would be the amount you would need to pay in by those dates I mentioned earlier. Okay, that would be the safe harbor. So the safe harbor is one of two things. 110% of last year or 90% of this year, 2026. Well, here's the thing. You don't know what 90% of the current year is. What you do know, which is a fixed number, assuming you file your tax return, what 110% of last year is. So here's a takeaway. If you're having a big year in 2026 relative to last year, you could overpay your taxes from a standpoint of paying more than the safe harbor when you only had to pay that money later in the year. I'm gonna give you an example. So like I told you, let's just say last year was $100,000 of tax and your safe harbor for 2026 would be 110. What happens when ultimately you file 2026 and the tax was 200 grand? Well, you could have just paid the 110 throughout the year and paid the 90,000, that difference, when you file your tax return in April. And that is what trips up a lot of people, is that there's two calculations running. There's the safe harbor, meaning what you're supposed to pay quarterly, which again is the lesser of 110% of last year or 90% of the current year. And then the second thing would be is, okay, you've met the safe harbor for not having a penalty for paying your taxes quarterly, but do you now owe money? So two different things. But here's where the strategy comes in. Let's say, again, because we're looking at your data, and you always hear me say this, but if you don't have good accounting data, we're not doing sophisticated planning like this because we're literally flying blind. But let's just say we have good accounting data and we have it. And I'm projecting, I know you're going to have tax of 200 grand, but I know last year's safe harbor would be 110. I'm telling you along the way, hey, let's pay 27.5 per quarter, knowing that it really should be probably 50 if we're paying on the current year, but we won't be penalized. But I'm telling you to set the money aside in a high yield savings account or an escrow or a money market account. So we're doing two things. We're avoiding paying the IRS a penalty or interest by not meeting the safe harbor. And two, we're saving the ultimate balance due that we'll have to pay at April 15th in a separate account and getting a return on that. And so I've seen this too many people where they'll overpay because they don't have a current year estimate, either good or bad, and they'll miss out on the opportunity to have their money working for them. So the takeaway is this. If you're not working with somebody throughout the year and they just file your tax return and they hand you, hey, based on what we see on this year's tax return, here's the estimate you got to pay for next year, but then you're not dynamically looking at what's happening in the current year, you really could be missing out in one of two ways. You would be very surprised that you either owe money or getting a big refund, or two, or I'll give you three things. You could owe a penalty for not paying the right numbers, and three, you didn't have your money working for you throughout the year. So these are just some of the things I'm trying to unpack with people about paying their taxes quarterly. So just quick recap, seeing some people jump on, some people jump off. To avoid penalties, and really it's an interest. It's 6 to 7% of interest right now based on the current IRS rates. From your taxes as an individual, you've got to pay in 110% of last year, so 2025's tax, or 90% of this year, whatever is less. So again, there's strategies around that. I've kind of listed them out. But when doing this, if you're working with somebody, it can really almost pay for itself in terms of the planning, peace of mind with the money set aside, and also opportunity cost that you didn't squander by putting your money away in something that could be interest bearing while you knew you would have to pay that tax later. At least you had your money working for you. So anyway, we work with people all the time on these strategies, but it's because we have access to their bookkeeping, or we do it, we can really do these advanced planning strategies. So if you got a question or a comment, drop it below. I would love to answer it, because chances are the question you have somebody else has, and so we can help somebody else out. All right, guys, we'll see you on the next one.